Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Welcome back, everybody. Today we're going to talk about how gaining skill sets for trading in the stock market and the options market can help your family gain financial leverage, which is God's secret to wealth creation. All right, so what I'd like to do today is just take some actual examples of kind of where we are in the marketplace. Now, this is September the 8th, 2021. So if you're listening to this out there in the future, you can actually go back to a chart and take your chart back to September the 8th, 2021. You can actually see these examples because right now in real time, this is real. This is what I would be doing in a market like we have right now. Now, we're in a bull market and Joe Biden is the president. And so this market, we would think probably the first 4 years of his presidency, it's going to, probably remain a bull market, at least the first couple of years. And then towards the latter part of his reign as president, it might go sideways a little bit like it did in the Jimmy Carter years. And that's just a thesis, right? But right now, it is still a bull market, but it's kind of cooling off. So one strategy we could think of is called the rolling stock strategy. For this example, I prefer to do it with options, though, not stocks. So it's going to be the rolling options strategy. And if you go out to TRADEway.com/memberships and check out Trader Pro, that membership will teach you from the ground floor of knowing nothing about stock trading to the point where you'll learn how to do the rolling stock, and then you'll learn how to do that with options rather than actually buying the stock. You can buy options, which are cheaper, so you can get more shares. It'll show you all that. So this strategy will be included in that membership. Now, we're going to do the rolling options, and I'm looking at a stock right now called AMAT. That's the ticker symbol, and it's Applied Materials, Inc. It's a semiconductor company. And what I've noticed is several of the semiconductor companies right now are rolling. In other words, the stock is moving sideways. This particular stock, for about 3 months, it's been rolling between about $130 per share and $140 per share. That's nice. You see, that's a $10 roll. And you know what's interesting about it, only takes a little bit less than 2 weeks for it to make that move up. So that means you can have your profit in 2 weeks. Now, it may take another 2 weeks for it to move back down to the buy point, bounce up a little bit, and then you would buy it again. And 2 weeks later, you have another profit. Okay, now guys, remember, this is an academic example by the time you hear this, because even though this is a good play for right now, by the time you hear it, I'm not recommending AMAT, because who knows, things can change, right? So it's an academic example from your viewpoint. Also, if you don't have the skill sets to do this, I don't recommend trying it, okay? Because every strategy we teach at TRADEway, we got a whole set of rules, and you've got to keep the rules to get the math on your side. All right, so this one started rolling around May the 24th, 2021. AMAT, that's the ticker symbol, and it did 5 rolls ending around August 31st, 2021. Right now it's September 8th, so we're actually watching this stock again to see if it might pull back down to 130 and bounce up a little bit and create another good buy point, which I'm pretty sure it will do. So I'll be watching this stock probably within the next week. It's going to give us another opportunity to do another up play, which in options, that would be a call option. You would buy a call option if you think the stock's going to go up. So that's what we're going to do in this example. So I want you to picture, and this is a little bit harder in a podcast than if we had video, right, where you could see everything. But picture a stock that's just moving sideways and rolling about every 2 weeks. It rolls up from $130 to $140, and then it turns and heads down and takes about 2 weeks to roll back down to 130. Then it turns and heads back up. Takes about 2 weeks to get back to 140. And it just keeps doing that again and again, about 5 times over a 3.5 month period. So if you can visualize that, you can see what we're doing here. Now, here's what I want to do though, because in the last episode, we were talking about the difference between long-term investing and trading, and how long-term investing does not create wealth. It's for people who are already wealthy, but trading gives you the potential to create wealth. So I'm going to show you this example two ways. First of all, let's do the long-term buy and hold, which is what the world wants you to think you have to do. And they want to do it for you. That way they earn commissions, right? So they don't want you to learn these skill sets, but they're just skill sets. Doesn't take that long to learn how to do these things. If you go out to TRADEway.com/memberships and check out Trader Pro, you can get started. But let's look at the buy and hold first and pretend you just gave your money to someone else. And what we're going to do to make this apples and apples is we're going to go out there and do the same time period. So this play took about 3 months and 9 days. So let's pretend that you bought the stock and you held it the whole time. You didn't trade it, you just hold it. And that will depict investing. So we bought the stock on 5/24/21, and we're going to invest $12,250 in this example. Let's say that's the amount you have to trade with. Well, that stock is $130 per share, so we could get about 90 shares. Let's pretend we don't know how to do options. We don't really know how to do anything. We're just going to try buying a stock and holding it. So we buy 90 shares. The stock is at $130.47. So that's an investment of $11,742, roughly $12,000, right? And we hold that for 3 months and 9 days. And during that time, the stock moves up so that on August 31st, 2021, it has moved up to $136 and we sell it for a profit. So we made a $498 profit. Okay. So we invested $12,000 roughly, and we made $498. That's about a 2.23% return on investment. Now, if you annualize that, and by that I mean, let's assume we could do that 4 more times, a similar play 4 times in a year, then we would actually make about 8.11% return. And oddly enough, what's funny about that is at TRADEway, we use that 8% is kind of roughly what financial advisors tend to make in a year. You know, good years, bad years, they average out, they make you about 8%. And you've been trained to think 8% in a year is great, haven't you? So now that's investing, and you can kind of see how you're not going to create wealth if you start with a fairly small amount of money and you only make 8% a year, right? But let's look at this same exact trade where we're investing about $12,250, but now we've gone out to TRADEway.com/memberships and we signed up for Trader Pro and we took the course and we got the coaching and we did everything it took to learn these skill sets and get pretty good at this. So now we know how to buy call options. So now this time we're going to go out to the same stock on the same day, May 24th, 2021. And now since we're going to buy the call options, we don't have to pay $130 per share. We can buy a call option for $12.25 per share. So with the same $12,250, we can buy 1,000 shares now rather than only 90 shares. So now we've already begun to leverage because our money, every dollar we have, is worth about $10. You see that? So we're leveraging our money by having these skill sets. Now, the guys on Wall Street, these people that we're leveraging their brains, for one thing. They invented options. We didn't even have stock options in this country until 1973, which was a year after I graduated from high school. So my grandfather, whom I learned stock trading from, did not know how to do options because they didn't exist, right? So I had to learn that. But I learned it, then I taught it to my children, and now we're teaching it to our grandchildren, and we're teaching it to thousands of people around the country. So stock options trading is so fantastic because now you're taking the brains of the people on Wall Street who created this for themselves to make billions of dollars, trillions of dollars, right? And we're realizing that God used them to actually put it on the shelf for his people. That's us, right? So we can trade options. So now we can control 1,000 shares rather than 90 shares. Now think about that. Let's just round that up, say 100 shares. If you only had 100 shares and the stock goes up $5, how much do you make? You make $500, right? $5 times 100 shares. You make $500. But if you had 1,000, you make $5,000 in the same time period with the same investment. Think about that. That's leverage. So now every dollar is worth about $10. So we buy 1,000 shares at $12.50, and that's our $12,250 investment. So we invested roughly the same amount as we did in the buy and hold. So that means we're taking the same risk, all things equal. We're risking $12,250 in the market. Now, 2 weeks later, on June the 1st, this stock has rolled up from $130 to $141. Now that call option gains value as the stock does. That's what call options do. So now, rather than $12.25 per share, that option is now worth $17.40 a share. So we sell it for that times 1,000 shares, and that gives us a $5,165 profit for that 2-week period. Now think about it. In the buy and hold example, we held it for 3 months and we made less than $500. Now we put the same amount of money in, and in 2 weeks we made $5,000. It didn't take 3 months to make $500. It took 2 weeks to make $5,161. So can you see this is going to work out better? Because guess what? It rolls 5 times during that same time period. So now we just wait about 2 weeks for that stock to roll back down close to 130, where our buy point is. And guess what? It does that by June 21st. So on June 21st, it has rolled back down and hit $130 and bounced up a little. So now it's at $131.20, right? But guess what? We've got $5,000 more than we had when we started, because on our first little roll, when we invested $12,250, we made $5,165. So now we've got $17,000, so we can buy more shares. This time, instead of investing 1,000 shares, we're going to invest in 1,300. So now you can see another form of leverage. When we're doing options, every time we buy again, since we make money, we can buy more shares. And that's adding more and more to the leverage. So now, instead of buying 1,000 shares of the options and selling 1,000 shares, we're buying 1,300 shares. So that cost us $12.50 per share for the call options times 1,300 shares. That's $16,250. We've got that money in the account because we made that extra $5,000, right? All right, so 2 weeks later, it rolls back up to 140 again. In fact, a little higher than that. On June 28th, it reaches $140.90, and we sell the call options. They've moved from $12.50 to $17.25 per share, so they put $22,425 in our account. Well, we invested $16,000. Subtract the two numbers, you made $6,175 profit on that roll. So we made it a little bit more because we had more shares. Guess what? We got more money now. So this time, when it rolls back down on July the 8th, we can buy 1,700 shares instead of 1,300. So the stock rolls back down, hits 130, bounces up to about $131.61. We buy 1,700 shares of these call options at $12.50 a share. That's $21,250. 2 weeks later, on July 14th, it rolls up to $139.88. The call option's now worth $16.54. So we made another $6,859 in profit. Now we can buy even more shares. So it rolls back down, and 2 weeks later, roughly on about July 20th, it hits 130 again. This time, instead of buying 1,700 shares, we can buy 2,300 shares with the money that we have in our account because we've been making a profit every roll. So now we invest that money. 2 weeks later, it rolls up to $139.88. We sell the 2,300 shares of the call options, and we make an $11,132 profit. It rolls back down. It hits our buy point, about $130 per share on August 23rd. We buy 3,200 shares because we have more money. It rolls back up, and this time it doesn't quite make it. And there's a little bit of a correction in the market around August 31st, just a few days ago. And at that point, the second day, one day it kind of moved down instead of up, and the next day it started moving down again, so we sold it. We didn't quite make as much profit, but we made some because The call option was $12 per share when we bought this batch, and now it's $14.90. We'll go ahead and sort of stop it out for a profit. And we make $9,280 on a roll that didn't quite work right. Now, if you add down that profit column, we made $5,165 on the first roll, $6,175 on the second roll, $6,859 on the third roll, $11,132 on the fourth, and then $9,280 on this last one. Add that up, that's $38,612 over the same 3 month and 9 days. Now, when we did the buy and hold over 3 month and 9 day period with roughly $12,000 investment, we made $500, 2.23%. By using the skill sets that we learned with Trader Pro out there at TRADEway.com/memberships, now we've able to take that same $12,250 over the same 3 month and 9 day period. Instead of making $500, we made $38,612. That's a 315% return rather than a 2% return. If you annualize that one, it's about 1,162% return. So that sounds crazy, doesn't it? But let me explain what that is. That means if you did this play 4 more times in the year, which you would have time to do that in 12 months, or you found a stock similar to this at least 4 more times in the year, then you would actually make 1,162% if you had no losses. So in the real world, you're going to have some stop outs. And secondly, the market may not present that exact opportunity 4 times in a year because it may switch to a bear market. You may have different opportunities, but not the same one. So you may not ever make 1,162%. But why do we even annualize them? Well, because if you had 4 different plays that were similar with 4 different stocks, how would you know which one to do? You would actually calculate the annualized percentage before you did the play, and whichever had the highest one, that's the one you would choose. So it's used to help you choose. Let's say you only had enough money to do one stock play, but you had 4 great stocks. Which one would you pick? Well, that helps you know which one to pick. So that's why we annualize. But let's go back to what the real return is. The real return on the buy and hold was 2.23%. The real return on this play was 315%. That's really what we're interested in, isn't it? Think about that now. Just because of skill sets. You know how the Bible says knowledge is better than gold? This kind of proves it, doesn't it? So we gained skill sets over someone that doesn't really know anything other than just to buy and hold. And now we've learned how to do a rolling option strategy. And wow, that'll get you. You know what? My goal is to make you lose a little bit of sleep at night. Now, I got to remind you, this is an academic example for you because you're listening to this at least sometime after September 8th, right? And this play started on May 24th, 2021, ended August 31st, 2021. So, but it gives you a great idea of what can be done with the leverage of options. Now, let's take a different strategy that we could do in the same market we have now, a similar market, where it's kind of, it's been a really hot bull market, but now it may be cooling off a little bit, going a little bit more sideways, but still a bull market. But before I do that, let me mention one other thing here about TRADEway.com/memberships and the Trader Pro. When you take advantage of that membership, you get a thing called the A+ stock list along with that, where we have selected roughly 100 stocks at any given time that are the best growth stocks in the world for you to look at, and you can pick the 1 or 2 or 3 that you're interested in. That way the fundamental analysis is already done for you. Because remember, it takes 3 legs on the trading table to have the potential for a good trade. You have to know the fundamentals. Is it a great company, great products, great management, etc.? Secondly, you have to have the technical analysis where you know how to chart. And thirdly, you got to know the market tone, how the news affects it. Well, we help you with that with Trader Pro. We're going to help you with the market tone because it takes years to figure out how to do that. So we're just going to do that for you. And we're also going to provide this great basket of super stocks with great fundamentals that you can choose from. So that's part of Trader Pro, and that's great. But in that particular stock basket, the one called the A+ list is where you would have found the example that we just did. And like I said, there were actually 3 stocks in there at the same time that actually would have been great for that rolling option strategy. Now, also, you're going to find a list called the less than $30 list, which is kind of a group of stocks we've created that are lower dollar stocks. And you can use those for buying outright stocks because you can get more shares because they're cheaper. But you can also find some pretty good ones in there to do options plays. So I'm going to choose one from that $30 or less list, and it's called DBX. All right. So here's another academic example that actually was done right about the time we did this recording, which is September 8th, 2021. And this is an ongoing play that could continue also, but probably by the time you listen to this, it's academic. It wouldn't necessarily be the right stock to use. So keep that in mind. But with this particular stock, there's another strategy that you learn in Trader Pro in that particular membership. In past episodes, we've done examples of bull put spreads, which is a particular type of spread called a credit spread. And you've seen quite a few of those examples on these podcasts, but we've never done a debit spread example. So I'm going to give that example right now. The debit spread is something you learn as one of the more advanced strategies in the Trader Pro membership. And it's a great little strategy to use when a market may be cooling off a little and you don't want to be in the market so long. Maybe you don't want to buy a stock and have that risk for 2 whole weeks or 3 weeks, like the previous example. What if you wanted to get a play done in 3 or 4 days or even 2 days and be done with it and grab your money, right? So that's what a debit spread is really good for. And so this particular example, we're going to look at the stock DBX, which is Dropbox. A lot of you have heard of Dropbox because you use it on your laptops. And so Dropbox is a great little company. So we're going to go back to August 27th, 2021. And we're going to take a look at this. And on August 27th, this stock was in an uptrending pattern. It wasn't rolling sideways like our previous example. This is an uptrending pattern. And if you look back at it, one of the things you learn in Trader Pro is you learn how to draw support and resistance lines. The support line is kind of where the stock tends to hit a bottom and bounce back up. And we teach you how to use moving averages to help know where to put that bottom line. And stocks will choose either the 10, the 20, or the 50-day moving average normally to bounce up off of, and this one has chosen the 20. It loves to bounce up every time it hits the 20-day moving average, and it's been doing this for about 4 months. So it'll pull back down to the 20-day moving average. It'll bounce up a little bit, and that would be your buy point, even if you're doing call options, just regular plays. But this debit spread, this is actually called a bull call spread. And you kind of think of this as an up play, kind of like a call option play would be an up play. So you want to do this when you think the stock's going to go up. So when do we think this stock would go up? Well, we think it'll go up when it gets to the 20-day moving average. It tends to bounce up off of it. Well, in this case, it had actually had a little bit of a market correction, maybe due to its earnings report. Earnings season was going on recently, and it kind of fell down below that 20-day moving average. And it took about 2 weeks, and all of a sudden it meandered its way back up and got back on top of it and bounced up. So that's a buy point, all right, because it loves to go up from the 20. So on August 27th, it actually bounced up and reached about $31.13. And so in a bull call spread, what we're going to do is we're going to buy an at-the-money call option. And I know this may sound like Greek to you, but remember, it's just skill sets. And if you go out to TRADEway.com/memberships, select Trader Pro, and you go through that training course, you're going to learn how to do this, and it'll teach you all the terminology. It's not that much. It's just that Wall Street likes to make up words that are hard for you to know what they mean because they want to trade your money for you. They don't want you to learn how to do it. It's not that hard to learn. So you go out there, you learn the terminology, and what we're going to actually do is we're going to buy the September 10th call option, and we're going to buy it at a strike price that's as close to the actual stock price as we can. Well, the stock's at $31.13, so we're going to buy the $31 strike price call option. And that, if you go out in your trading software that your brokerage company provides for you, and you go in and you look at the option chain, you'll see that that particular option would have been 63 cents by 68 cents, which means we would have to buy it for about 68 cents per share. All right, in this example, we're going to do 1,000 shares, okay? So we're going to purchase that, and At the same time, now that's what's cool about a spread is you actually have two legs on this play all at one time. So not only are we going to buy a call option, we're going to sell one at the same time. And we're going to sell a call option that's at a little bit higher strike price. So I'm going to pick a strike price that's kind of higher than where I think it's actually going to go over the time period that I'm doing the play. But I don't want to get it too high, because if I get it too high, I don't make any money. Because the farther up I go, the less money they pay me. See? So I'm going to pick 33. And what's interesting, it doesn't look like a lot of money. It's 2 cents by 3 cents. That's not paying me much money, is it? But it's a little bit of money. So they're actually paying me some money that I can put to decrease my risk on buying the call options that I'm purchasing. So that gives me a net debit of a minus 66 cents. And what that means is it's actually like a play that cost me 66 cents per share to do the play. So if I'm doing 1,000 shares, then that's $680 that I'm spending. And I made about $20 on the ones I sold. So that's worth having, right? So that took $20 worth of risk off the play. A net debit of $660. So now we didn't want to be in the market more than 3 or 4 days, right? So we're just going to decide to unwind this play on September 3rd, 2021. Now what happens is stock moved up like we thought it would. It moved up from $31.13 a share to $32.39 a share. So what we do to unwind the play is we do the opposite of what we did to get into the spread. So remember, we bought a call, a $31 call option, and we sold the 33 strike price call option. So now we're going to reverse that. We're going to sell the one we bought and buy the one we sold, and that gets you out of the play. So now we're going to sell the $31 call option, but it's gone up because the stock went up. So if you remember, we bought it for about 68 cents a share. Now it's gone up to $1.55 by $1.58. So we can sell it for $1.55. So that's a profit. So we sell our 1,000 shares for $1.55, and now we're going to have to buy back the one we sold. And remember, we didn't sell it for much. It was like a couple of cents per share, which gave us about $20, but now it's worthless. It's 0 by 1 cent. So we buy it back, it costs us $10. So we made $10 profit on that leg, but it does decrease the risk. And that's the point of doing a spread. So now when you look at the whole thing, you sell for a profit and then you buy back for a small loss there. And so we made $1,550. Costs us $10 to buy back the option that we sold, but we make $1,550. So you do the math on that, it's $880 profit on 1,000 shares, right? So we had an investment of $660, but we made more than we invested. So that's more than 100%, isn't it, on the return? We made $880 over just a 3 or 4 day period. So actually, the return is 133.33%. Now that's pretty amazing, especially when you consider that we're only in the play less than 2 weeks. So technically, you could do, I don't know, if you annualize that, it's a crazy number. It's 3,466% return. And that just assumes if you did this same play every 3 or 4 days for a whole year. Now that's not going to happen in the real world, but still, we annualize it so that we can compare this to maybe 3 other stocks we could have done this with and make it apples and apples. So let's just look at the real return. 133% in 3 or 4 days. That's just crazy money, isn't it? So that's what's great about the debit spread is it actually has the best math behind it of just about anything that you're going to learn. Starting out from zero and going all the way out to these advanced strategies in the Trader Pro. It's just got one of the greatest returns. It's a little bit risky, so you want to make sure you don't put more in the play than you'd be willing to stop out on a regular call option play, right? So, in this case, we put $660 in the play. So would we be willing to have stopped out of a regular call option that might have made us $5,000, but if it didn't work, we lose $600? Yeah, we would. So that's a reasonable amount to put in a debit spread. So that just gives you a taste of how these things work and a couple of great strategies that you can use in a market kind of like we have right now. And remember, the date is September 8th, 2021. You say, well, how's that going to do me any good in the future? Well, because markets kind of repeat themselves. There will be another day where you're in a bull market that may be cooling off a little bit, which is kind of the scenario right now. So you might say, well, why do you even have these two strategies if you think you're in a market that's cooling off? Well, because the debit spread, you can get in and out in 3 or 4 days, which is great if you think the market may not keep going up. But the other cool thing is the other example that I gave earlier, a lot of times when these markets cool off and they were a hot bull and now they're just kind of cooling off, a whole lot of stocks start rolling. So the rolling option strategy works great in a market that's cooling off because they stop uptrending and they start rolling. So you have lots of examples that you can go out and find of great stocks that you can do the rolling stock strategy. So the rolling stock strategy and the bull call spread work when you think the market is cooling off a little bit, but it's still a bull market. All right, well, I hope that's interesting to you. It should make you lose a little sleep at night when you start looking at these numbers, and I hope it does. But here's what I'd like you to do is go out to TRADEway.com/memberships and check out the Trader Pro and get started. Look, you can't get there if you don't start, right? So now is the best time to start. So I hope you enjoyed this show. If you did, I hope you'll rate and review it, because that way people that have similar interests to you can go out and find it. We can help some other folks too. All right. Hope you enjoyed it. Have a great day. We'll see you next time.